Hey guys, I wanted to kind of display something for you. So I'm really into stocks and I really love investing, and I've been trying to be as much of a steward, to the game as anything else. So I want to show you a chart here I kind of put together. Excuse my message wrong, but it's to describe a principle. So right here, this represents 100% of the high that during each one of these cycles the actual stock market reached. And this is the number of days since they reached that high. So in essence, 100% of the high is on the 0 days, and then 100 days out from the high shows you each one of these metrics. So what I wanted to explain to you and show you is cycles do not follow exact patterns. Now, so to give you an idea, this is the dot-com crash. So what you're going to see is the dot-com crash, here was 100% of the high, then it started to come down. It didn't drop too much, It didn't actually all the way up until roughly between 200 and 300 days did the actual stock market drop 25% from its all-time high. Then it continued to kind of go down, and as you can see, you have up patterns and down patterns until it finally hit 50% of its all-time high that it reached on that dot-com bubble, all the way out 600 days or a little under 2 years later. Now what you're going to see right here is the Nixon shock. So this Nixon shock, you can kind of see where it kind of came down here once again. It didn't quite get all the way down until it reaching about 75% drop or 25% drop until about mid 250 days. And then you can kind of come see it kind of bounce back up. Once again, trickled down until it reached about 50% of that all-time high it reached. About 450 days roughly, and it's like well over a year did it reach that point. Then you're going to come down here and we're going to go ahead and we're going to see the Great Depression. Obviously, the Great Depression was a huge fall. We almost saw, within 100 days, it hitting 50% of the all-time high. So extremely violent and extremely fast. And you could see that that market move was all over, and we ended up coming all the way down here to how much the stock market actually fell. So it was a very long, very drawn out, very volatile. So what we saw is it come down, it bounced back up, was an unrealistic high, and it retraced, and it kept retracing as more and more earnings came out and more data came out. And then what's going to go to the financial crisis. During the financial crisis, obviously, came out. We all remember this one most recently came out. We really didn't even see it drop. The stock market dropped 25% within the first 100 days. It wasn't until we really saw it actually start to come down. We didn't really, after over 200 days, did we really see a full 25% retracement from that high. And then all the data started coming out. All the banks started collapsing. And we saw this very, very, very violent fall when we saw a little bit of a dead cat bounce right here. And we ended up being roughly about a year into it, we broke that 50% retracement mark. But you'll notice what happens. It comes out, it does some pretty stable, and then it has a big drop off and a slight bounce before it kind of continues that. Now, lastly, what I want to show is the coronavirus, and why I've painted each one of these diagrams is to show how different this is than anything we've seen before. And so anybody that says, oh, this is just like any other recession or this or that, what people have to understand is the housing market and bad loans, ninjas loans, right? What I call them, no income, no assets, no job, and you could still get a loan, right? That was a super prominent thing. Bad loans and a real estate bubble caused a recession last time, okay? Now this time, a recession could cause house prices to go down. It's very different. You understand that concept, right? One, house prices and bad loans caused a recession. This is we're being forced into a recession because we're pausing the economy to go ahead and actually potentially drop house prices. Why? Because less people on the market, financing tightens up, all these things. So the coronavirus is much more similar to like an economic disaster, an actual natural disaster like Harvey, right? It's sudden. It's not this something that people expect. It's wham, it hits you and everything comes to a stop. So it's much more effective like Harvey, like for example in Houston, right? It slammed Houston out of nowhere, completely collapsed our economy, shut down the court systems. People had to be laid off of their jobs. It was very dramatic, very sudden, and it was not something, it was an act of God, like a pandemic is, correct, right? So you can see in the coronavirus what happens here on this line. Wham! We get slammed down immediately. We get a little bit of a bounce, and wham! Look how fast we went down. Just like the Great Depression, right? We saw that major, and then here we are on this retracement. And so the reason why I wanted to show this chart specifically is anybody that claims they know what's going to happen in the stock market is full of shit. It is. Okay, right? They are. Because as you can see here, all of these recessions were all caused by something else. The dot-com bubble, the Nixon shock, a financial crisis of bad loans, Great Depression, okay, right? These were all caused. None of these were caused by an actual, real act of God or pandemic, which is why we see the coronavirus so different. There is not one single pattern of any of these other recessions that represent exactly what's happening on in the coronavirus. So the key is with investing, invest early, invest often, invest consistently, and invest for the long term in the stock market. Companies will rebound. People will continue to see profits of their business as this passes. This is not going to stop ambition. People are innovative. They will find ways constantly to adapt to an ever-changing market. Don't try to time the market. You won't be able to time it. As you can see on here on these charts, not one of these charts is going to tell you exactly how we're going to play out here. So the key is invest consistently, invest often, invest in great companies that are innovated, and invest for the long term, and you'll come out ahead.